Canada increased its trend-setting rate another 25 basis points, taking the rate to 5%. That's the highest that we've seen in this country. In part, the Bank of Canada decided to do so because growth has been coming in hotter than expected, but it's also going to take longer, in their estimation, to hit their inflation targets. We've been talking for the first half hour with Robert Kavcic, senior economist at BMO Capital Markets, Jim Thorne, chief market strategist at Wellington-Altus Private Wealth, and we've also got Barry Fenton, CEO of Lanterra Developments, joining us on the desk because, of course, the most interest rate sensitive part of the market, Barry, is housing. You build that through your condo developments. How are you thinking about the latest rate hike?
Well, I was actually pretty happy that we finally know certainty of where he's going. I think basically and I listened to the esteemed panel a few minutes ago, that they really think that we're near the end on increasing rates. But I've always thought that the interest rate component doesn't really it's not the full driver of where our market is.
But to your point that you now have certainty as a builder, as a capital allocator, what does this do for you? Because I know when we've talked in the past, you have pulled back on some projects, or you're doing your homework a little bit with a high watermark because of the environment and the kind of returns you need to generate.
Well, I think that from people that are purchasing our product, when you look at the fact that in the first quarter of 2023, Canada increased population by 700,000, which is like that. We haven't seen that in 50 years. And I think for the fact that people love our class of asset, I think we're going to continue to go. I think from our standpoint at Lanterra, we are now looking at relaunching and reloading some of the projects that we were on hold.
So if you think, and we have talked about immigration, is this rate hike going to do anything to dampen enthusiasm? Because, you know, that's where we're looking for the wind to come out of, is the housing market.
Well, I mean, I've always been a proponent of, I think even if you increased rates another 1%, as long as we knew that there was certainty in the market and we were done, I think that the market will continue to do very well. And when you look at the Canadian market in Ontario, for example, over the last year, we're probably down 10% from top to bottom on valuations. Most of it has happened in the Milton areas and the Brampton areas. But I think that once we stop the interest rate increases, or at least people think that there's certainty, we're going to be way on fire.
Robert, the Bank of Canada has cut rates in hot housing markets before, right? When we had energy shocks, when we had other shocks. But it seems like today that is the guiding post, but it doesn't always have to be. Is there a scenario where they let housing move up as long as they're seeing progress on jobs, a looser job market? How do you think about that?
Yeah, it's obviously not the only thing they're considering, right? They're considering everything in the broad 2% inflation target context, but it's a big factor. And I mean, look back over the course of the last cycle, and I would completely agree that fundamentally we have an extremely strong supply and demand situation in Canada, and specifically Ontario, underpinning the housing market. And that's why it's really hard to drive a material long-term correction, because there is that fundamental demand there, and we just cannot build enough, especially single detached. But the problem is when the bank cuts rates to levels that are far too accommodative and leaves them there for far too long, as we saw in 2021, you see a lot of froth build up on top of that fundamental base. And over the last year and a half, they've taken that froth out of the market. And so now we're at a level where rates are closer to where they should be, maybe a little bit on the restrictive side. That froth is gone, and the market has kind of rebalanced itself based on those underlying fundamentals.
Jim, why can't we just hang out here at 5% and not break anything? Things might get squeezed, but, you know, if you look at the trajectory so far, we haven't broken anything.
No, economy's slowing, but if you take the real, not the full, what the CP, if you X out what the Bank of Canada is doing, real rates in Canada, real overnight rates are about 2.5%, right? It's the highest we've seen. And debt matters, right? Debt to personal debt to disposable income is the highest in the G7, right? So what's different this time, and this is why I go back to why the inflationary pressures of what the Bank of Canada is doing, is we have an economy that is driven by credit and debt. To think that interest rates, and to be able not to be able to sit there and say interest rates are the price of credit, is a price in itself. So yeah, it should be at 5%. We should stop. That's what we've been advocating since the end of last year. Let's just see how this plays out. Look, I lived in the States. I used to bring my friends up from the States. You guys, your housing market never stopped. Never stopped. I lived in Washington, D.C. The housing market in Washington, D.C. I lived in the 6th most affluent county in the United States. Wiped out. Suicides. Businesses going down. That's what I keep saying to you. You guys want a housing correction? Right? You don't know what you're living. You don't know what you're praying
if it's
for.
housing correction, maybe a little bit of a cool down. It sounds like, from your perspective, at 5%, we're not going to get a crisis.
Look, I keep suggesting the same thing. This whole situation over the last 2 years is not about slowing down a real estate market. The real estate market is going to continue to be there. It's the best class of asset to own. And whether we go up 10% or 20% or 30% over the next 3 years, I think we're going to be higher. But the point is that what's causing this problem? The problem is that we went through a COVID period. We have wars surrounding us. I mean, we have uncertain times around the world. So that's really what we're dealing with here. We're not dealing with the fact of how do we cool down a real estate market in order to bring interest rates down, in my humble opinion.
Can I ask a question? Because the data that I look at on building permits, right, it says that over the last 12 months in Canada, building permits are down almost 65 basis points, which traditionally on a 12-month period, building permits grow close to 1%. So you've seen your industry contract. Right, so this interest rate policy, and then you have S&P Global in their PMI that for Canada, which is for 2 months in a row below 50. They say record high interest rates in uncertain macro environment has affected businesses in Canada, right? So the Bank of Canada policy is affecting.
Listen, I'm not a numbers guy like you, but I can tell you that the supply-demand issue is here. The fact is, it is true that there's less people going out to build today. It's because we as developers aren't 100% sure what the final costing is going to be. We hate building product or selling product 4 years ago and delivering it back to the market in 3 years later and not making a lot of money. That formulation doesn't work. But I can tell you that we can look at the numbers and say housing starts are down. It is, for sure. But that just tells me that our housing market is going to be substantially stronger in price over the next 3 years. So people are going to want to continue to buy assets. So I don't look at all we're down 0.25% or we're down 0.5% on permits. That's not what's driving it.